What is going on, guys? This is the episode 2 of our live stream. Thanks for watching our video. Our video dropped today on leases. And we are happy and excited to be able to just come on and answer any questions you guys might have. Specifically, this topic is something that is near and dear to our specific
interest, the investment interest, for sure.
We see leases and everything on every single file. So how we use rental income and leases and how it's shown by different lenders is probably one of the most important things you could possibly kind of take into consideration when looking at buying a house. This can either be a make or a break depending on how much money you make. So we wanted to basically jump on here and talk to you guys about what that looks like and how it can benefit your applications.
Yeah, so the big thing, obviously, for most of our investors out there is you guys are obviously looking to get into the investment space because you want to be able to use that rental income to help, create passive income for you guys, or also to be able to help use that rental income for your next real estate purchase. So being able to use your leases to the full advantage is obviously advantageous for you guys. So just some things that we want you guys to consider, moving forward when you're with your purchases. So first thing, we're going to kind of just start with some basics here. So on the majority of all applications right now, lenders, we're doing this a little bit before COVID, but it's really become, standard now that COVID's kind of had its full effect. A lot of lenders are looking for 6 or 3 months worth of rental reserves for all rental properties on the application. So this means including like your subject purchase. So if you are looking at purchasing another rental, you're going to have at least 3 months rental reserves for that property, as well as every other non-subject rental property on your application. So keep that in mind. That could be an important question to ask up front to your mortgage agent, especially because some banks, like I said, are requiring 6 months and not 3 months, which can get pretty pricey pretty quickly.
Yeah, something to also take into consideration is that when they say rental reserves, they don't just mean on the subject property. They could possibly mean on your entire rental portfolio. So the reason they basically did this was because the majority of the deferrals during COVID specifically had to do with rentals. And they obviously were sick of the deferrals happening. So they decided they were going to implement this process to ensure that the people who are actually getting loans have the ability to be able to service those loans. So that's specifically why they got into it. So when you're factoring in how much down payment do I need, how much is it a commercial property, a residential property, all those tenants that are paying you rent that you're relying on to pay this mortgage, you might actually have to have that in your bank account prior to close.
Yeah, they just want a screenshot just to show that you guys have the rental income. And that rental income can't be part of your down payment or the closing costs. So you guys are going to have separate amount of reserves set aside other than your closing costs and down payment. So keep that in mind as well too. Moving forward, being able to use rental income on your application, there's a few things the banks are going to want to see. Ideally, you've had that lease in place for at least a year. And a lot of banks are going to want to see that income being claimed on your T1 tax return. So they'll ask for both your T1, which is a standard document that we collect anyways, but they may also ask for a statement of your rental earnings as well too. That statement of rental earnings is going to break down all the income derived from your rental properties, and they'll make sure that it matches up with your T1. So keep that in mind as well too. If you don't claim it on your T1, you could definitely run into some pushback and some red flags from the bank, and there could be a possibility that they don't let you either use your specific rent, or they may make you use a fair market rent analysis done by an appraiser. So keep that in mind. If you have had your property for less than a year, there's a few things that banks can want to see. Ideally, you have 6 months of rent coming in, shown by bank statements. So pull up 6 months, show the deposits going in. That's really the minimum that they'd want to see, other than a year. Some banks will make an exception, and the minimum that they would really make that exception for is 3 months of rental deposits. So last month's rent doesn't typically count just because that month hasn't actually happened yet. I get that last month is deposited most times, but from the bank's view, they don't like to include that last month deposit because it doesn't truly count from their eyes. So they're going to want to see a first month and then second and third months to really make an exception. But again, it really comes down to how well of a case that we can put together for the banks as well. And one of the things that they're going to take a look at when making that exception for like a 6 or 3 months rental income is what portion of your qualifying income does that rental income classify as. So if you're qualifying for a property and the rental income that you're claiming makes up 50% or greater of your total qualifying income, they may have a hard time letting you use that rental income that's only been going on for, if you've only had 2 deposits, they may not allow that. If you've had 3 deposits and it makes up 60% of your rental income, they may have some issues with that. So keep that in mind as well too, especially just because we know a lot of you are aggressively buying, and there are going to be times when you've had a purchase maybe a few months apart. That may be something that you run into.
So another thing to consider is depending on the tier of lender you're looking to use, such as an A lender or a B lender. Some A lenders actually won't allow you to use fair market rent to the full equity takeout or purchase amount if that fair market rent document's used. So for example, First National is a great example of this. So if you're purchasing a rental property, that rental property does not have any rent in there. You're not assuming those rents, and you need a fair market rent analysis to be able to use the rent to qualify. First National will only allow you to up to 65% loan to value on that property, whereas there are other lenders out there who will allow you to either purchase or refi to the full 80% using fair market rent analysis. So it's really important to understand what lender out there you're going to be able to use to be able to make that refi or purchase. Again, if your ratios are that triple AAA, you're within your ratios and you don't need that rental income to qualify, no problem. You can get that mortgage without a doubt. But if you do need that income to qualify, it's important to note that that there are certain parameters out there that lenders do use. We are finding that a lot of people who are using fair market rent is usually on the B side, to be honest with you. A lot of them are trying to scale their portfolio anyways, and they're trying to either create more cash flow by buying these alternate properties or turning single family homes into maybe a legal duplex and all those different things. There's a bunch of different creative financing solutions that we're using in place currently. So the fair market rent analysis is important to understand, and it's definitely a tool that you can use in your investor tool bag to be able to scale that portfolio. They usually cost around, I want to say, a few $100s. That few $100s is nominal compared to how much it's actually going to help you qualify. Yeah, so we actually have Shahir. He's going to be joining our live stream as well. We're going to get him on there.
There he is.
The man, the myth, the legend.
How's it going, guys?
What's going on, man? How are you?
I'm doing great. How are you?
Doing well. 1 second.
Nice. You guys are killing it, eh? You guys are just...
I'm getting an echo here. 1 second.
Are you?
I'm doing well, buddy. How are you?
I'm doing fantastic. Can't complain, right? Just getting more deals under contract, and yeah, it's more of a repetition game, right?
Yeah. So I think we'd love to kind of hear how your experience has been from the wholesale side. I know what it's like from our side right now, and the market's been super hot from some of the leads that we've been getting in from realtors and just talking to all the investors as well too. So what are you kind of seeing on your side from the wholesaler? Are you getting a lot of appetite from homeowners to be able to, get rid of their, or I shouldn't say get rid of, but, being interested in selling their properties privately to you guys? What's kind of their appetite with the market, and how do you guys see COVID kind of affecting that?
Yeah, so I'll start when COVID actually was in effect back in March. So when COVID actually became a thing, we did notice a bit of a slowdown when investors were actually looking to put their money down on properties. So even though we'd get properties under contract, people would be like, investors specifically would be like, you know what, maybe I'm going to hold on for a few weeks or a few months or whatnot, right? So that's what I was experiencing. Now, today, my main market is Waterloo, Kitchener, Cambridge, and there's so much demand over there that I've actually shifted my business model. So before, I used to target a lot of investors to buy properties. Now I deal with a lot of realtors who have retail buyers that are just looking to get into a property, right? So one of the main reasons why I chose that strategy was because I was networking with so many different realtors, and they used to tell me like, dude, Shahir, you got to come into the Kitchener market because there's so much demand that my retail buyers, they're losing out on, like they're being outbidded, right? So there's no opportunity for them to actually get a property. So if I even get a property for, let's just say 20,000, 30,000 under market, or even a property that I actually assigned yesterday that was just a property without any realtor's commission, and someone was able to buy it, right? So
yeah,
so there's so much demand that the opportunity is there. It's just finding the properties and just finding the motivated buyers to actually purchase it.
Absolutely. I mean, I'm sure there's a whole lot of motivated buyers out there right now. I mean, you take a look at some of these properties that are being listed. I mean, even in the middle of COVID, we're still finding deals that come in that are $50,000 to $80,000 over asking price, and there's definitely still a demand from investors and homeowners out there. Even though given we're in the middle of a pandemic and all that's going on as well too.
Mm-hmm. Yeah, one of the main differences that I've noticed is obviously in different markets there are different situations. Like when I was focusing in the St. Thomas market, obviously the sellers, they were more lenient in terms of price. In Kitchener, sellers think their price, like their home is worth over $1 million, right? Because of the media and whatnot. So St. Thomas, smaller area, reasonable people. Kitchener, unreasonable people, higher prices. But I wouldn't say it's a bit tougher to find investors to invest in St. Thomas, since it's such like a niche
Yeah.
market. A lot of investors are like, you know what, is it going to grow that much? Okay, so it's riding in the back of London. You know what, I might as well invest in London rather than St. Thomas, right? But in Kitchener, a lot of people like to say KWC, it's kind of recession proof because there's so many industries over there. So people are just looking to buy properties where it's hot, right? So one of the troubles I'm having in Kitchener is just getting a property under contract, right? But I have a lot of demand. I have a lot of buyers there. One of the issues I'm having in St. Thomas is that I get properties under contract, but it needs to be a deal, right? It just can't be like a property that's $30,000 under market. No investor would buy it, right? So these are the different things I'm noticing in each and every market that I've actually entered through. So yeah, it's interesting out there.
Yeah, and I think going back, I think Matt says this a lot where, and I've had a couple newer investors ask me kind of what the best strategy is when you're first starting out. And, instead of looking at properties and trying to compare properties in Kitchener and in Brampton and in St. Thomas and London and Windsor and Sarnia, each market, as you said, is going to be different in terms of what the demand is for sellers and for buyers. So, that really comes into play when you're first starting out is, it's really hard to compare a duplex in the GTA area or the KWC area versus Sarnia and Windsor. And, if you're looking to start out, maybe one of the best things is to, maybe not become a master, but become very familiar with an area that you want to invest in, because trying to compare properties in cities that are, a few hundred kilometers apart, you're going to be looking at two different market influences, two different types of buyers and sellers, and it's going to have a really hard time. The investors are going to have a hard time trying to compare them, and it might, it's going to be a lot of spinning the wheels on something where it might be easier just to stick in one market and really become efficient in that market, and then start to move into different markets as you become more comfortable.
Yeah. So going back to your statement there, it's funny because with all the wholesalers, once we're dominating a market, we're so happy, we're getting deals, everything's good, we're making money. But now since we dominated that market, what's next, right? And I feel like with each wholesaler that we have, they're different stages in their careers, right? It's that stage of where they're about to get their first deal, they're not that confident. They're like, okay, is it possible for me? Is this my reality? And then they get their first deal, and then they get into a market, they're dominating that market. And then from there on, they dominate it and they saturate it. So now there's no more deals there. So they're like, okay, I got to pivot. So I believe that pivot is so important, be able to adapt to a different market right away, so that consistency is there. Because I believe one of the biggest mistakes that I made is I took way too long to get out of St. Thomas. I just kept saturating because I was like, there's more deals, there's more opportunity to be had there. But I should have immediately, like after my second fly drop that I got no deals out of, and I sent like 15,000 each drop, didn't get any deals out of. I was like, okay, you know what? Now it's time to pivot to a different market, and that's when I moved to Cambridge, and I saturated Cambridge. Now I'm going towards Kitchener. I'm going to saturate Kitchener, then I'm going to go to Waterloo. I'm going to saturate Waterloo, and then I'm going to think from there on. So,
for sure. One of the things that we can kind of relate to in that statement is just being able to pivot your business in general, being able to adapt and take action fast. The idea is, I think Grant Cardone talks about it all the time. It's like so many people are just sitting on the sidelines and they're just, they're like, what if I do this? And they're going to sit there and they're going to plan it out, but they're going to plan it out for so long that someone else is going to take the opportunity. So take that opportunity and go out there and just take action towards that decision. And the majority of the time, probably 90% of the time we've ever had to make a decision, making that decision has turned out. Indecision is what's going to be the death of you. So, making sure that's you're making those decisions on a daily basis is super important.
When you're wholesaling your deals and you're finding buyers, do you have conversations with investors, just inquiring like how new they are to the investing game, and do you notice one market that's been better for new investors versus more experienced investors? Do you kind of see a pattern of where we start out with and then maybe where they turn to after they've done a few deals in that area?
Yeah, I guess when it comes to investors, the first thing that I ask them is like, how much capital do you actually have? Like, how much can you put down? How much can you leverage? Because like, it's funny because you guys are the ones that I know personally are the only mortgage brokers that solely focus on investors. I couldn't name you another mortgage team or any mortgage brokers out there that are as competent. So going back, getting the financing straight, like that's my first criteria. If you don't have financing, I'm not going to really pay attention to you that much. However, I always go back to like, hey, if you can leverage, let's just say $300,000, this is your first time, let's go to a smaller market where returns are guaranteed and it's not as risky, right? If an investor is buying a large multifamily property right away, let's say in Kitchener, and doesn't really know what he or she is doing, then I'll be kind of hesitant to go towards them, because then I would have to hold their hand through each and every process. And this is why with me, I'm in that stage of wholesaling where I only deal with repeat buyers, right? I only deal with buyers who I know that will close on time and have the cash readily available. It just creates so much more opportunity for us to build a longer relationship further down the road too. Obviously, I'm very open to new investors coming in and investing with me as well. But that track record is very important to me, because I remember I had a deal in St. Thomas. It's funny, it just closed recently. It was a 13-unit building. I'm not sure if you guys recall. It was supposed to close in March, right? Brand new investors, 2 brand new investors. It actually closed a few days back, and they didn't close on it. I had to find another buyer, but their deposit was collateral at the seller's lawyers and trust. So that was my first lesson of like, hey, you know what, and that was more of a different situation too, because it was all built on emotions, right? When investors first come in, they see the numbers, everything is good, but a lot of it wasn't much on data. And that's what I learned the most, is that first we have to make sure that, hey, you're capable of doing such a project like this, right? Or so going back to your original question, cut it short, is that I would always tell them to invest in a smaller city, because obviously the returns would be much higher and it would be risk adverse. So that would be mine.
For sure, touching on what you said about setting expectations and making sure that you can actually fulfill the conditions that you're looking into. We deal with a handful of people all the time, and a lot of people come to us either with like an idea or a deal, and they'll be like, look, I want to get in this deal, but this is what I got. Let's put everything on the table and let's figure it out. So we'll find solutions. A lot of it's refi purchase. So a lot of it is having to set an expectation about time frame at the end of the day. So if you go to a client or somebody who's an investor and you lock him up in 30 days, and you're like, look, in 30 days from now, you got to close on this. And then they come to a mortgage broker and they're like, look, all my money's in my house. you got some problems. So,
Mhm.
so being able to set that expectation with your broker, or work with somebody who can either set you up to have cash available and then be able to execute when you have that money. Being able to set those steps preemptively to understand where you're going to be to close is the most important thing, because we run into situations where there's clients like 2, 3, 4, 5 days before closing, things come up, and it's like you definitely could have kind of not had to deal with these things if 2 or 3 months ago when you were starting your journey we could have had a conversation about maybe you should max out your line of credit to buy this, because then your debt servicing is no longer going to work for this deal. Or there's a handful of different like strategies for different investing purposes. So like if you're going to be flipping, there's definitely a strategy to do that over purchasing multifamily residences.
Right.
We try to figure out the strategy first, then the cash and the equity, and then once you have everything kind of laid out, then the deal. Then it's like, okay, you can purchase this multifamily, or you have the cash to do this or that. A lot of people unfortunately get so excited because it's so exciting. You're listening to you're listening to Matt, you're listening to all these people. These people are telling you take action, do these things. But a lot of people need to just go back and realize, take a look at their finances first. But at the end of the day, if you don't have any money and you don't have your finances in order, even if you somehow stumble into a property, how are you going to manage that property? How are you going to manage your finances after that? How are you going to grow? Like, a lot of people just need to, I guess, realize or have a conversation with somebody who knows what they're doing to be able to kind of get that done.
Yeah, if you're in the right position to purchase, I mean, that asset really quickly turns into a liability, right? So that's definitely something you got to make sure you're in a strong financial position to be able to make that purchase. And if you're in a position where you have to close privately, one thing that we've always stressed on, I think we've always said in all our videos too, is making sure that there's a really strong exit strategy, because you don't want to get stuck in that private deal. And another thing to consider too, and for a lot of the investors out there, is with how quick some of these turnarounds are for these off-market deals. Keep in mind that there's a really big difference between closing on a fourplex and closing on even a fiveplex, a sixplex, and upwards, because there are a lot of banks out there where as soon as that turns into a 5 or 6plex, you're technically in commercial land. And commercial land, your time to closing, is an additional 2 to 3 weeks sometimes, depending on the size of the building when it's commercial. So, if you're an investor out there and you find an off-market deal, make sure you check the closing, and feel free to run it by us too. If you have a listing and you want to know whether or not you can afford it before you go in and make any offers on it, bring it by us. We'll definitely run the application scenario, make sure it fits your debt ratios and you're in a position to financially afford it. But we'll also take a look at it, and it's great if you can afford a funding, but if you have a commercial deal that closes in 3 weeks, you're not gonna be able to get it done at an A bank anyways, just with the timeline. So that might be something where we have to close on it privately, just get you into the property. And then after, 6 to 8 months, we take a look at refinancing you out into some sort of A or alternate lender. Because we have had a couple commercial properties that have come by us, and the timeline was just, it's hairline tight. Like, there wasn't much room for error. And, banks are pretty backed up these days with how hot the market is. So, even if you bring us a deal on time, sometimes with the length of time in processing and underwriters right now, that can sometimes push timelines too out of reach as well too. So that's something to consider as well.
Yeah, a lot like the pressure from you guys. Whereas if like you're in a hot market and people want to offload the properties really quickly, that's a pressure that you guys get on your side to set expectations. But on our side, the market ebbs and flows through seasons. So there's hot seasons and cool seasons, and sometimes those hot seasons, we can move fast, but if we're relying on underwriters and BDMs and banks to be able to do their job properly, setting that expectation is it has to be realistic. So having a team where you understand your side and their financing understands their side, and then they can set expectations to understanding the entire deal, it causes a lot of people to have a more smooth deal than having stressed out clients, which can be difficult to deal with.
Yeah, and do you guys mainly focus on new investors or experienced investors? Like, what do you think?
All shapes and sizes, really.
Yeah, column A and B.
Yeah, I find we definitely have more benefits. We have benefits. Each different client has their own benefits, right? So a new investor who may not know the terms or just how to navigate the market, can benefit from us from just understanding the processes of just, how to go through a mortgage process and what the closing process is, and what kind of costs and fees and just a general handheld on the first couple of deals through the process, right? Whereas a more senior investor who's maybe maxed out their A side limit, maybe they got 4 or 5 properties, maybe there are 6, maybe they got lucky and they were able to negotiate with the banks and get them to go an extra couple properties with them. Maybe they're looking to grow to 10 now and they're looking for somebody else to be able to step in and help them go from 6 to 10 properties. That's where we can kind of come in and be able to provide those B lender solutions and be able to provide them with some options to get them to continuously increase their portfolio past what the limit of the big 6 banks. Typically, they limit them at 4 rentals and then maybe 1. You get a primary residence and maybe a secondary home. So you already got 6 properties in total there. It can be pretty tough to get another rental property on top of that with the AAA lender. So that's where we're able to come in. And for those more senior guys who already have 10 plus rental properties, maybe they're looking to make the move into the commercial industry as well too. We're able to help them with their commercial purchases as well. So the new guys and the more senior guys, they both have their areas where they may need a little bit of advice on, and we're able to help them out on both sides of the coin.
Gotcha. And I'm just going to shoot some questions out at you because I know you guys are the experts, and these are also questions I've been asked a lot by investors. The first question is, in terms of an A lender, who do you think on the top 5 banks are the easiest to deal with or the most lenient?
Okay, so I can answer that.
Okay.
So, BMO, obviously, is geared towards investors. BMO, like most people, if you're an investor, BMO will work with you. RBC is by far the bank that will push the most deals through for you. And so the reason why, in short term, is that RBC covers their losses with CMHC. So what happens is, if a bank, if CMHC, if a mortgage goes into default, then a bank has to cover the CMHC, has to deal with CMHC, and CMHC loses money, then they their standing changes with the bank. So what happened is RBC covers their losses with CMHC, meaning CMHC will hypothetically just kind of let them do what they want because they can cover the loss. So RBC doesn't interfere with CMHC, although CMHC still does the insurance on the back end. So RBC, as long as they feel comfortable with your loan, they will do things that other banks will not do. Now, that being said, the broker channel does not have access to RBC. RBC is cut off any business with brokers. So the only way to get RBC loans is through the RBC bank or a mobile mortgage specialist. We would love to be able to work with RBC, but unfortunately, they do not allow us to.
If there's any RBC reps listening, we would love to work with you guys.
But that being said, so TD also has a fantastic rental program as well for any investor who's looking to scale their portfolio. They have something called a debt wash. Basically, in layman's terms, a debt wash, if your property is, it's kind of like almost like a commercial mortgage, where if your property is debt servicing at a 1 to 1.2, meaning for every dollar it costs, you're making 20 cents on it, they'll actually completely wash it, meaning they'll take it off your application, and all you need to do is qualify for your personal residence and your next purchase. They'll do that up to 5 properties. So, they make it easy for somebody to scale as long as the investments that they're purchasing, have high cash flow. So there are a few banks that have each individual perks that go along with it, but that being said, RBC is the best, and unfortunately, we don't have access.
Wow. Is there a specific reason why they won't give you access to that?
They stopped access a long time ago.
Yeah, I don't know why. I think it's just it helps them stay competitive, to be honest.
Gotcha.
You limit outside influence from the broker channel. It just means everybody has to go in directly through the bank. That's just kind of my guess. I don't really have an exact reason or.
Yeah, I wish they would tell us, but unfortunately they don't.
They
didn't disclose it. We do have a question real quick. I don't mean to cut you off. I know you have a bunch of questions. We can get back to it in a second.
Don't worry.
Joshua Grant just asked us a question. Said, for a owned business, if you already have a separate business, example a franchise, how can earnings from that business be considered during a mortgage application for a B lender? It's an interesting question. So. lenders will not allow you to purchase, well, not unless you're McDonald's, but lenders won't allow you to purchase property in an operating company. So you have to have a holding company that owns your real estate, and then you can personally guarantee your real estate through the holding company. If your operating company owns a holding company and you are making it is very, very, very established and you are making some serious cash, there are banks out there who will give you loans. Now you're talking serious amounts of money to be able to do that, but you can't purchase, at least not that I'm aware of, you can't purchase property through an operating company. It has to be through a holdings company.
But in terms of using that income, we're going to take a look at how you pay yourself. So whether you're paying yourself, like a T4, like if you own the business, whether that's a sole proprietor or whether you're incorporated, we're going to take a look at how you pay yourself. It's going to fall under standard income qualifications. So they're going to want to see, like a 2-year average of your T4s, or if you're paying yourself like a T5 dividend. We can sit down with you. We can go through your income, making sure that you have the right documentation to show and to help qualify. It's really pretty standard to be able to use the actual documents. The difference, like Josh said, depends on whether you're looking to purchase it through that like a holding company, or whether you're trying to purchase it through an operating company, which you're definitely going to run into a lot of red flags.
Yeah, so like every good business owner, you probably write your income down to nothing. I mean, it's probably a prudent thing to do. And then you keep a lot of your retained earnings in your operating company. Now, that being said, if, for example, you're a sole proprietor and you only claim a certain amount of money, there are ways to be able to use more income than what you claim on your T1 to be able to qualify. Some lenders will take a look at bank statements and they will derive your income from bank statements. They'll basically look at all the income, they'll look at all your liabilities, and then they'll minus your income from your liabilities, and they have a calculation that they use to be able to use more income than what normally you would qualify for. But there are some minimum qualifications. You do have to be in business for 2 years. They do want to see that, they'll verify that through a handful of different documents as well. So, business for self, it's one of the most rewarding things you could possibly do in life. You're working for yourself, you're grinding. Highly recommended for anybody who wants to actually have some true, real success. There's nothing more satisfying than being able to work for yourself and be able to help people with a passion every single day. But the banks, unfortunately, don't make it easy for people because you're more of a risk in regards to your income. So there are obviously solutions out there, but they're a little bit a few extra steps involved, that's for sure.
Yeah, and then I just want to touch on that quick before we jump back in there. I actually just dealt with a client where we ran into this situation where he was an incorporated business owner. And because of that, they had taken advantage of some tax advantages. And they had an initial shareholder loan that was used to start the company and kind of get it off the ground when they had first started. And instead of paying that loan off, they had actually used it and carried it through as a deficit to be able to help with their taxes moving forward. And that helped with just claiming their income down the road. But one of the things that the banks are going to do when they take a look at payments coming from a company, especially corporations, they're going to take a look at your financial statements. So in this case, unfortunately, the bank found it a little bit risky to be lending to someone that continuously showed deficits year over year, because from a lender standpoint, they look at the most extreme risk cases. So if you're continuously showing this large deficit year after year after year to a bank, that means that there's a very easy chance that you could potentially go bankrupt, any day, because you're not showing any retained earnings into the company. So how could you possibly, afford to pay yourself and any of your employees, right? Even though in most circumstances, banks understand that most businesses do have 2 balance sheets. They have the ones that they show the accountant and the one that they show the bank. But the ones that you show the bank, those are the ones that really matter. And if it's you can have your tax advantages or you can have your purchasing advantages, but you definitely don't get both of them. So you guys got to sit down and realize, or consider, what are my goals and what do I want to be able to do down the road? And I think that's something they should do, whether you're owning a business or just starting an investment, is, figure out what your goals are and go from there. Because if your goals are to buy, and like I said, you're taking advantages of tax laws, it's really going to hinder your ability to purchase down the road.
You can't evade the tax man and afford your house. Like you don't get both.
Nice.
I think Jeff Wilo had a question up there too, and it was how much to break mortgages early. So it's a good question. There's a couple different answers to that. There's two real exit penalties that the banks are going to have. The first one is going to be a 3 months interest penalty. Typically, it depends on where you're at in the term, and that is because the other penalty is an interest rate differential penalty. How the interest rate differential penalty works is it's a bit complicated, but it essentially comes down to they're going to take a look at your current term rate. So if you're in a 5-year term and your rate was 2.09, and let's say you wanted to break within your second year, they're going to take a look at what you have remaining on your term. So if you had 3 years remaining, they're going to take a look at what that 3-year interest rate would be, and they're basically going to find out the difference in what you would owe them. And if that is more expensive than what your 3 months interest penalty is, and which it usually is by quite a decent amount, you're going to be stuck with your IRD, that interest rate differential. Now that's for a fixed rate mortgage. On the variable rates, you're typically just looking at a 3 months interest penalty when you're exiting out early. So a couple options to consider.
Is this the famous Jack Live? Oh, I thought Jack ran him over. Oh, Peter's a funny guy.
Quick
Yeah,
question.
yeah.
Quick question. So with the early payment, are you does it differ between A lenders and B lenders and private lenders? Well, private lenders obviously, but like with A lenders and B lenders, does it differ in terms of the penalty?
I would say it like.
Like, does it differ? You mean like
Yeah,
are they different?
Like are they different? Like different processes? Yeah.
The majority of A lenders and B lenders are the same. They're either the standard cost of break is usually 3 months interest or the interest rate differential. Now that being said, lenders take a look at interest rate differential differently. So there are different calculations depending on the lender, and one could be very costly and one could be obviously more beneficial to you. So it's important that your mortgage broker realizes that before they put you into a loan.
Yeah, and it can be it's very much term dependent. So one of the things that we look at is what's your goal with this property. If you're looking to do a BRRRR purchase and you know that I'm going to have all my renovations done in at least 6 months, and I can definitely refinance within the year. Well, then there's no sense to go with like a 2 or a 3 year term, because if you're trying to get out in that first year, you're definitely going to be paying some sort of interest rate differential, and we've seen interest rate differential penalties up between like $10,000 to $15,000. So it doesn't make sense to have that longer term. We'll usually put them in a 1 year term. That means increases the likelihood and makes it pretty likely that they're just going to be paying that 3 months interest penalty, and that's going to reduce the expenses to exit. Another thing to consider too when we're talking about B lenders is there are a lot of A lenders out there who offer a B-side program. So some of these A lenders and B lenders are really the same bank. It's just a different product. So there's a big difference between a B bank or a B lender and then versus like a B product. So First National has a B product, even though they are an A lending bank. Another one out there is XMC as well too. XMC has an A side and a B side product. It's not always, and I think it kind of comes down to that whole stigma around the banks is, it's not always just a B bank. It's an A bank that just sometimes offers an alternate product. So you're still getting the same bank, the same service. It just offers a product tailored to the B side. So in those circumstances, it's going to be the same exit penalty in most cases. Private can different. Usually it's a bit of a hybrid. Can be a hybrid. So sometimes we'll see a 6 months close, and then after the 6 month, it can be open. 3 months.
It really just depends on your term. So what happens is it's a 3 months interest penalty. So for anybody who's taking a private mortgage, or if you don't know, each individual month is a interest only payment. So your entire private mortgage is an interest only payment. So technically, you're paying 3 months of mortgage payments to break your term early, unless you have an open term or it's stipulated directly in your contract that you can break at any time. Again, really important to understand that before you get into a loan, especially depending on the strategy you're looking to implement. If you're doing a quick flip, probably not the best idea to get into a 1 year closed term. You're going to have to bite the bullet on 3 months penalty if you want to break early. Whereas if you're looking to stay into it and you want to refinance in a year and that's your timeline, then that 1 year closed is probably good. Also, something to note is if you are requesting an open term, odds are the private lender is going to add some sort of extra fee or a boost to the rate in which you're paying, to offer you that service. So flipping, I always like to flip the perspective a little bit and take a look at the other person's perspective. So from like an investor perspective, it's all about me and how can I save money. But from a private lender's perspective, it's a business. This is how I feed my family. Either this is how I'm running my business. This is how I make money. So for somebody to give you an open term, that's them not, guaranteeing or realizing a certain amount of profit per year, right? So it's important to realize that they're also in it to make money. So the majority of the open terms we're looking at, a lot of them are institutional open terms, so they have like a large book of business that they can afford to give open loans for. The majority of mom and pops, a lot of them lock in their terms for a year contract.
Sweet. I've actually came through a situation recently. It was through a seller. And obviously, the seller deferred their mortgage payments right from the beginning, from March. And obviously, she was locked in a 25-year amortization period. And she was with Equifax. She tried to cancel it. Equifax was charging her close to like $20,000 for the cancellation, because they added up the entire mortgage plus the cancellation. So we're still in the midst of figuring that out. But have you heard of that?
You mean Equitable?
Equitable Bank?
Equitable.
Yes, that's Equifax is
Equifax is the credit score.
I was like, damn, man, they charging people now. So again, when you get into these terms, these alternative terms or these private terms, understanding contract, so you're legally bound by a contract. So what the penalty that you have to break these terms. If you're in it for, say, that sounds like an interest rate differential, to be honest with you. If she has a long term and she's really just started her term and she wants to break that mortgage, the cost for her to break that mortgage, that's a real.
Were they charging her to break, or was it she had deferred her mortgage and they were asking her to back pay what they hadn't paid?
Both.
Okay, so yeah, so something that a lot of people need to realize too is deferrals. Like, each lender has their own different way of enacting a deferral. So some people essentially just push the interest to the back. So in that case, if you defer, your mortgages and you take 6 months off and then you try to get out of your mortgage through a refinance or a sale, yeah, they could definitely ask you to make up your missed payments. Deferrals don't cancel your payments. You're just deferring them to the back end. And there are some banks out there who could potentially charge interest on the interest if you deferred it as well too. So, if you're looking at deferring, first off, make sure you actually need to defer, your mortgage. I had talked to a credit representative of one of the banks that we work with, and she brought up a point. And one of the things they first teach us in when you get your mortgage license is there's the 5 C's of credit. One of them is character. And she said, "Why am I going to give someone a mortgage when I see that they're working, they have a good income, they're bringing in rental income, they haven't said anything about their tenants being laid off or anything, and they automatically defer all 5 of their mortgages and blah, blah, blah." She's like, "Why would I give them a mortgage when I know that the first chance that they're going to take to get out of it or push their payments or do something like that, that they're going to take full advantage of it?" And, that character ethic of it really comes into play in that, in that position. And banks don't have to give you a mortgage. Like, when we do our underwriting and we make sure that, if this bank is a triangle, we make your application a triangle and it gets in through the hole, and then their underwriters and their credit team takes a look at it. Just because it fits their numbers, it doesn't mean that they have to actually give you a mortgage. So if we put it in and they see something, even though your ratios and your credit score works, if they don't like a certain part of the aspect of the ratio, they can turn around and cancel it and decline it and send it back. So, if they see that you're being relatively unethical or your character isn't in good standing, they have all right to turn around and decline the client. And a lot of time, if they have deferrals, one of the stipulations on the commitment is that all referrals are back to active status. So, if you are thinking that you can kind of just take advantage of that and increase your cash flow, if you go to buy a property, you're gonna have to put all those properties back onto active status anyways. So it kind of defeats the purpose, to be honest.
And lenders aren't in the business of giving you new loans while you can't pay the ones you have.
Exactly.
Yeah. Gotcha.
Yeah, it's COVID brought up a bunch of interesting situations. So we haven't seen mass mortgage deferrals. I don't think I ever saw a mortgage deferral until COVID. It was just unheard of.
Yeah.
Like, very, very specific circumstances, but huge amounts of people did use it, whether they needed it or not, and ramifications are coming. Like, for people who think that same as, I guess I don't have to get into the CERB, but same as the CERB.
Yeah.
People who didn't need it, like, you think it's just gonna, it's just gonna blow over and they're gonna forget about it. Like, there will be ramifications.
Yeah,
Lenders will see it.
Yeah, and another thing to consider too is like when 50% of all the mortgage holders defer their mortgages and it's all rental properties, like, I mean, the bank knows what your property is, right? Like, that's why we take the application. They know it's a rental property. When they see that, 80% of the people who have a rental property have deferred it, it's gonna affect change on the rental market. So rates are gonna go up, loan to values are gonna change, and that's what we saw. We saw a lot of banks increase their rental rates and scaled back on their loan to values. So when we get, an investor who's applying for a mortgage and he's like, why am I going to 75% LTV or 70% LTV and not 80? And then we open up his credit application and he's got 5 deferred mortgages, and I say, well, it's because of you. like when banks stop making their money, they're going to enact a change on the market to make people, they got to make up for it, right? So, you have to be aware of the own change that you are enacting on the entire economy of the mortgage industry. If you were someone who took advantage of the deferrals and didn't need to, you had an effect on some of the changes that were brought into the mortgage industry. So, you do directly affect the rates and the loan to values out there through your actions. So definitely something to keep in mind.
Long-winded answer, apologize.
Very true. Are you guys actively investing right now?
We will be.
Yeah, we're looking for a multifamily right now in a few different areas. We're just trying to find the right one at the moment. I do a little bit of like private lending and stuff like that and move some money around that way, but we're looking to get into it. So if anybody knows, for business for self, you have to, again, you can't not pay taxes and qualify for a bunch of a house. So, fully commissioned salespeople, they do a really good job in being able to show a certain number on paper. So at the end of the day, we are looking. If you or any other wholesalers have any sweet multiplex deals, feel free to reach out to Aaron or myself.
Some super turnkey, 100% loan to value, strong take back.
Done. Only for you guys.
If you have
strong
any,
1% rule. We definitely want to get into it. We love the mortgage industry, but we don't want to be working 18 hours every day for the rest of our lives. So we want to start being able to build up our own passive income and start having that kind of income in to help offset, right? So we've seen the deals that you guys are getting off market, and we see what we're able to do for our investors, and it's about time that we got in. So yeah, we're in the next year we're making it a goal to get into at least 1 or 2 properties. So
nice. Likewise.
What about yourself?
With me, my biggest goal right now is just to acquire as much capital as possible with wholesaling. I remember when I didn't even know what wholesaling was, whether it existed or not, or whether it was illegal or not. I just wanted a vehicle to earn as much cash as possible. Like, I was even contemplating to become a mortgage agent. Yeah. This was like a year and a half back. I was thinking about it. REMIC or something like that. This organization, I was looking to actually do a course with them online and get my mortgage agent license. And then obviously I reached out to Matt, and that conversation started, and I became a full-time wholesaler, right? From here on, it's just about acquiring as much capital as possible. Like, my goal is to at least have $250K in the bank for me to utilize that to invest into other assets like private lending, businesses, even large multifamily properties, right? So with me, I don't want to be a wholesaler for the rest of my life, but this is a vehicle that I need to kind of work upon right now to achieve that goal long term. Same with you guys too, right? You guys don't want to be mortgage brokers. You want to be financially free. You want to be going on nice vacations. You want to be enjoying life to its fullest, right?
Absolutely.
For sure, man.
More than ever.
More than ever. Yeah.
Right now.
Yeah.
Long days get to you, man. But obviously, you see it. You know what it's like.
Mm-hmm.
That grind is a real thing. So we just got to keep pushing, and it'll happen.
Absolutely, sir. That's it.
Sure, you got any other questions, my friend?
Yeah. Another question. Now, with off-market properties and on-market properties, I've had mortgage brokers come to me and be like, "Hey, Shahir, you know what? I won't be able to give the mortgage to your client because it's an off-market, and it'll be more difficult for us to give it." Have you came across that situation where it's harder to get off-market loans than on-market?
I don't think I've ever had a deal canceled because of
Yeah.
an off-market deal. I think it's just a little bit more due diligence.
Okay.
Our lenders will just request an appraisal, and they obviously have something called an approved appraisers list, and that list basically just breaks down all the appraisers that they trust, and then as long as the value comes in where it needs to come in, they don't have any problem really doing it. Now that being said, assignment deals are a different story. So a lot of conventional lenders will only lend on either the original purchase price or the appraised value, whichever is lower. So if, for example, you have a deal at 500,000, you assign it for 540 or whatever, they're going to request the original purchase agreement, and at that point, your clients are the person who's going to buy it. If they want to do it with the bank, they're going to have to qualify for the loan at 500,000. So they're going to have their 80% loan to value at 500, and then plus the assignment fee. So at the end of the day, doing these assignment fees conventionally can be a little difficult on the residential side. Now, commercial is a little bit different. The majority of those guys are getting appraisals on the property, and they can do the loan based off the actual appraised value of the property.
So is it possible for them to finance the assignment fee from the bank?
So I heard a rumor the other day that RBC was offering it. Again, I wish I could go to RBC and ask them myself, but unfortunately I can't. Financing assignment fees, are going to be difficult. So Aaron and I are currently working on creating a lending product. We're not going to get into too much detail of it because it's not hashed out yet, but we're in current talks with the bank right now to have them finance wholesale properties. What would happen in a nutshell is they would just be comfortable with the value of the property. They'd go have a third party go and assess the property, and they would then lend on the value of the property. Now, I'm sure there'd be some sort of premium that they would charge to an investor to be able to do that, but it'd be much less than what private financing would be to get into that. Now, we obviously see not a loophole, but we see like a hole in the system in regards to people looking for financing and needing this financing. And as long as the value's there, I mean, your job is to go and find under market deal, and you're going to get paid for that. And it's an investor's job to find a solid opportunity, and they should be able to take advantage of that. But a bank should be able to see a true value of a property and lend off the true value of the property. And I understand there's some risk associated with a lender maybe not putting having any skin in the game, for example, depending on how low the value of the property is. But we're currently working on it with a bank to try to see what we can do about making it a little bit easier for our investors to get into these deals.
That would be cool, man. That would be cool. We need to do a deal together, man. So let me know if you have any clients in like Kitchener, Waterloo, Cambridge area, because I'm going to be doing a lot of flower drops there. Just going to be doubling down on it. So it would be a good start.
For sure, man. We can 100% do that.
Yeah, I think we definitely have a good service to add to the wholesaler side of it. Your job is to find a property and then offload it as quick as possible. And, in circumstances where you have someone who's interested, but maybe they don't have the down payment, or they don't have the income to support, like private options can be a pricey option, but they're a great option as an entrance into a property. If you're looking to minimize your startup capital in terms of your down payment, there are ways for us to get that loan to value a little bit higher than 75-80% on the private side, especially on undervalued properties. Like, we're able to structure these tiered lending systems where they're able to go approximately like 80% on the purchase and then 85% on the actual loan to value of the appraisal. So we can be a really great asset for wholesalers, because like I said, we have the ability to get buyers into properties in a timely manner and in those kind of unique situations where they're looking for some help. So yeah, we'd love to start working. We're working with a few of the wholesalers right now, but we'd definitely love to open our arms up to all the rest of you guys. So
100%. Yeah. Anything else?
Yeah, we appreciate you jumping on here, man. We always love chatting, and we've been saying that we got to get together. We are going to be we can take this off live too, but we're going to be in London on Monday. If you guys want to go grab some drinks,
let's do it.
Perfect. Right on. Well, we appreciate you very much. And for everybody
Absolutely.
else who's tuning in, guys, this is our second live stream. You know, we're looking forward to being able to do this every single Friday right after our videos drop. We're also looking to create more content to add more value. We're going to be shooting videos consistently for the next ever, hopefully, to try to add more value and just help people understand financing and how to scale your business. So if that interests you, feel free to please follow us on Instagram or on Facebook or on YouTube, and it'll really help us being able to increase our reach. So again, we appreciate everybody who logged on today. Shahir, we appreciate you.
I appreciate you
doing
too,
it again,
man.
buddy.
Thanks for stopping by.
Absolutely. Thanks, guys.
All right.
All right,
Cheers.
cheers.
Bye.
Bye.